America's ports are completely jammed, our busiest docks are slowing way down, and the entire supply chain is seizing up. Huge ships are stuck, thousands of trucks are waiting, and, all of this giant mess leads back to one single decision made in Washington, a new tariff on China that has massively backfired. Here's exactly what happened. The United States government imposed heavy new fees, over $3 billion worth, specifically targeting any ships built, owned, or operated by Chinese companies. The goal was simple: cut down China's power over global maritime trade. But the plan blew up instantly. Because Chinese companies are connected to shipping networks everywhere, the new rules didn't just hit China, they slammed nearly a third of the global shipping fleet. The result was an avalanche of new paperwork, customs inspections, insurance checks, and legal delays that ground the whole system to a painful crawl. Let's put this into perspective. One major shipping group, COSCO, faces an estimated $1.5 billion in new fees alone. These aren't just numbers on a spreadsheet, that's a cost that immediately gets passed down the line, eventually adding to the price of goods for average Americans, even before those goods leave the port. Port authorities were quickly overwhelmed, shipping companies faced impossible deadlines. The very tool meant to pressure China has now become a blockade against American ports, creating what experts are calling the worst logistical crisis since the pandemic. This was just the first domino. And what happened next was even more surprising. So, what did China do? They didn't panic about the new fees, they didn't even file a complaint, they just moved, quietly and efficiently. China began rerouting its giant container ships away from the United States. All those goods that used to head straight for Los Angeles and New York were sent somewhere else, primarily to Europe. Ports in the United Kingdom immediately saw a 30% surge in traffic. And this wasn't just some temporary change. This was a fundamental, strategic reshaping of global trade routes that had actually been decades in the making. This was no accident. It was a prepared strategy, years in development. While the United States was basically building a wall, China was opening new doors through its Belt and Road Initiative, really strengthening partnerships across Europe and Asia. They managed to turn an American policy designed to hurt them into their own advantage, securing better deals with other global partners. While United States importers face rising costs and empty shelves, the United States threw a punch and China simply stepped aside, leaving America stumbling forward, hitting nothing but air and, honestly, just watching its economic power leak away to competitors. And, the data doesn't lie. In the months right after the tariff announcement, Chinese exports to the European Union surged by over 12%, while their exports to the United States dropped by nearly 9%. This is not a small adjustment. It's a historic rerouting of the world's trade flows, and it happened in just a matter of weeks. While American ports are facing a major slowdown, a place across the Atlantic is seeing the exact opposite, a massive boom. Ports in the United Kingdom are busier than they've been in years. This isn't a coincidence. It's the direct result of China's strategic pivot. And it's turning the United Kingdom into Europe's new front door for Asian goods. Ports like Felixstowe and London Gateway are now operating at full capacity, cranes are working non-stop, and employment in these areas is surging. Where the United States sees expensive delays and logjams, the United Kingdom sees incredible opportunity and profit. They're capitalizing on a situation they didn't create, becoming the primary winner in this sudden shift. This redirection is more than just a temporary spike. It's a potential long-term realignment that could secure the United Kingdom's economic position for years to come, proving that in a global trade war, sometimes the biggest winners are the neutral gatekeepers. But the story doesn't end in Europe. China's redirection of trade is, supercharging an even bigger project, the rise of the BRICS alliance. This group, which includes economic giants like Brazil, India, and South Africa, is actively building its own trade network completely separate from the traditional Western systems. As China sends more goods through these new channels, it strengthens this parallel economy. They're conducting more business in their own currencies like the Chinese yuan and the Indian rupee, slowly but surely reducing the world's reliance on the US dollar. This is honestly the most profound long-term consequence of the US tariffs. A policy designed to isolate China has instead funded and accelerated the growth of its own economic alliance. The United States didn't just push China away, it actively pushed it into the arms of a ready and waiting alternative, making the BRICS bloc stronger, richer, and more united than ever before. Back in the United States, the consequences are hitting home hard. For American port workers, truck drivers, and warehouse employees, this isn't about distant global politics, it's about their paychecks. With fewer ships arriving, work is quickly drying up. Ports, that were once booming hubs of activity, are now seeing layoffs and reduced hours. This isn't just a port problem, it's a ripple effect spreading through the entire economy. Fewer ships mean less work for the truckers who move goods across the country. It means quieter shifts at the warehouses that store products. It hits local businesses, from the coffee shops to the gas stations that serve these workers. What started as a political decision in Washington is now causing real pain for working families across America's coastal cities, proving that in a trade conflict, the first casualties are often the people who move the world's goods. The impact is, really quantifiable. Industry analysts are already projecting a loss of over 15,000 jobs on the West Coast docks alone if this trend continues. Meanwhile, American businesses that depend on imported goods are facing, a perfect storm. They're caught between massive delays in getting their products and skyrocketing costs from the new fees. Major retailers and manufacturers are seeing their supply chains disrupted, their inventory levels plummeting, and their expenses climbing fast. These companies now face impossible choices: absorb the extra costs and watch profits disappear, or pass those costs along to consumers. Either way, American businesses lose their competitive edge. While their European counterparts are receiving goods smoothly and cheaply from China, U.S. companies are stuck in a painful cycle of delays and extra expenses. The very policy meant to protect American interests is instead putting its businesses at a severe disadvantage in the global marketplace. Consider a major U.S. furniture retailer. Their entire supply chain was built around containers arriving from China on a predictable schedule. Now, with delays stretching to 4 to 6 weeks, they can't stock their shelves. They're losing sales to European competitors, and they're forced to spend millions on emergency air freight to meet customer demand, a cost that is simply not sustainable. The smartest companies don't pick sides. While many American companies are struggling, some global corporations are finding a brilliant way to profit from this new reality. Take Airbus, for example. The European aerospace giant is doing something very clever. It's expanding production on both sides of the divide. They're growing their factory in Mobile, Alabama, while simultaneously expanding their assembly line in Tianjin, China. This is not a coincidence. It's actually a deliberate strategy to stay in favor with both the American and Chinese governments. By building planes in both markets, Airbus avoids tariffs, maintains full market access, and, keeps both superpowers happy. The Western alliance is fracturing. This situation is revealing something even more significant: deep cracks in the Western alliance. While the United States is trying to isolate China, Europe is moving in a completely different direction. European nations are happily accepting the redirected Chinese goods and investment, creating a major strategic divergence between old allies. When we look at the full picture, it becomes clear that the United States tariff move represents a major strategic misstep. Instead of weakening China, the policy has exposed a critical vulnerability in America's own approach. While China executed a long-planned trade diversion strategy, the United States' response looked, honestly, reactive and short-sighted. So, the fundamental problem wasn't really about the goal of addressing trade imbalances, but, honestly, it was the execution that caused issues. By creating a policy that disrupted global shipping lanes, America inadvertently hurt its own economy, while at the same time giving China the perfect excuse to accelerate its Belt and Road initiatives and strengthen those BRICS partnerships. The core of the misstep was a failure of anticipation. The United States assumed China would absorb the pain, but, Beijing had spent years building alternatives. They invested heavily in ports like Piraeus in Greece and Hambantota in Sri Lanka, creating a network that could bypass traditional Western hubs entirely. The United States targeted a single point in the chain, and China simply activated its massive network. So, where does this leave us? We're now facing a new global economic reality, one defined by fractured alliances and competing trade blocs. The old system of unified global trade is giving way to a divided landscape where countries and corporations must navigate between American and Chinese spheres of influence. For businesses, this means they must now develop dual strategies and supply chains. For nations, it means choosing between alignment with American policies or accessing Chinese markets and partnerships. And for everyday people, it likely means higher prices and more economic uncertainty. The United States tariff blowback has accelerated this fracture, proving that in today's interconnected world, economic weapons often backfire, and the path to prosperity lies not in isolation, but in smart engagement and adaptable strategies. The era of a single dominant global economic system is over. We are now entering a period of multipolar trade defined by regional blocks and strategic hedging. The question is no longer if the system will fracture, but how quickly and who is best prepared to adapt. For the United States, the path forward requires less reaction and more strategy. A lesson learned at a cost of billions and thousands of jobs.